Hi everyone, in this video, we'll explain the basics of share valuation using a real company example. We'll cover share types, key valuation methods, dividend growth, price multiples, and walk through a simple practical example. Let's get started.
Sierra Cables PLC, a leading cable manufacturer in Sri Lanka, supplying products to both local and international markets. The company has built a strong presence in the industry by providing a wide range of high-quality cables for construction, power, and communication needs. Being listed on the Colombo Stock Exchange means its financial performance is publicly available, which allows us to review actual data such as revenue, profits, dividend history, and key ratios. In this video, we'll take you through how share valuation methods, like the dividend discount model and price multiples, can be applied to this company's figures, helping us understand whether its shares are undervalued, fairly priced, or overpriced.
Hello and welcome. Today we are diving into the heart of the financial analysis with a topic every investor needs to master: share valuation. Everyone wondered how investors determine whether a company stock undervalued, overvalued, or correctly priced, or what the real intrinsic value of the share might be. Let's explore these questions through the real-world example of Sierra Cables PLC, a leading cable manufacturer in Sri Lanka. Now, let's into the company overview. Sierra Cables PLC, headquartered in Kaduvalam, has grown since its founding in 1999 into one of Sri Lanka's most respected cable manufacturers. The company is the third largest player in Sri Lanka's cable market, competing alongside industry giants like Sierra Cables and Kelani Cables. Revenue in fiscal year 2023 was around 7.7 billion with net income of 703 million, asset of 7.6 billion and equity of 4.3 billion. Part of the LOLC group, Sierra Cables enjoys strategic support from its parent Brown's Investment and maintains a credit rating of A+ with a stable outlook from Fitch Rating. Now, let me into the market share and share price. As of early June 2025, Sierra Cables PLC was trading at around 17 rupees per share on the Colombo Stock Exchange. After reporting a quarterly net loss in the latest quarter, the LOLC Group, through Brown's Investment, recently consolidated its ownership, eventually holding over 56% of Sierra Cables PLC following acquisition at 12.30 rupees per share in early 2025. In this video, you will learn define share valuation and why it's matter, and explore core valuation techniques including dividend discount models, price to earning ratios, and net asset value. Apply these models to Sierra Cables PLC, analyzing whether its current market price reflects its intrinsic value, and conclude whether Sierra Cables appears underpriced, fairly valued, or overvalued based on the analytical results. Thank you.
Hello everyone. Today I will explain some key concepts about shares and how we value them. Let's get it started. First, let's talk about the two main types of shares, ordinary shares and preference shares. Ordinary shares give you ownership in the company. You can vote and share profits, but dividends are granted. They depend on the company's performance. These shares are riskier, but offer higher returns if the company grows. Preference shares are different. They pay a fixed dividend and get priority when dividends are paid or if the company is shut down. But usually, you don't get voting right. Now, how do we find out what a share is worth? We use a method called Dividend Discount Model or DDM. It tells us that the value of the stock today equals the present value of the future dividend. There are two parts in DDM, holding period and dividend growth rate. I will explain the holding period and Imasha will explain the dividend growth rate. Let's start with the single holding period model. This is used when you plan to hold a stock for only 1 year. This is the formula. Value equals dividend plus selling price divided by 1 plus R. If the market price is lower than the share value, the share may be a good buy. Now, let's move into the multi-period. This is for when you hold the stock for several years, receiving dividends and each year selling at each year and selling at the end. If the market price is lower than the share value, this share also may be a good price. In both methods, we use a discount rate to bring future money back to its value today. That gives us more realistic view of what the stock is really worth. In summary, knowing how to value shares using dividend discount model helps us make smarter investment. Thank you.
Thank you. Now I explain a dividend growth rate model. A dividend growth rate model is a key factor in the dividend discount model, which helps us find the true value of share. There are three main types. First, zero growth. Where the dividend stays the same forever, this suits measure companies with little to no growth. Second, constant growth. Dividends increase at a steady rate. This is used for companies with stable, predictable growth. Third, differential growth. This is applied where a company grows quickly at first, then slows down. Choosing the correct model helps investors make better decisions by estimating a fair share price.
Hello everyone, I am Rashmi. So today I will be explaining the concept of price multiples used in comparative valuation, the widely used methods in finance to estimate the company values. So let's start with the basics. Comparative valuation. What do you mean by the comparative valuation? So comparative valuation helps investors to analyze the figure out whether the company fairly valued or undervalued or overvalued by comparing with it other similar companies in same industry. So to do this, we use something called price multiples. These are financial ratios that connect the company's market values to specific financial performance indicator like earnings, sales, or assets. Now let's take a closer look at the four main price multiples you should know. First, we have the price to earning ratio. This compares market price of a share to earning per share. In simple terms, it shows how much investors are willing to pay for 1 rupee of current earnings. If a company has a price high earning share ratio, it usually means investors are expecting strong future growth. So this growth is most meaningful for the companies that have a steady, reliable profits. So let's now examine the formula used to calculate the ratios. So first of all, PE ratio should be mean as share price divided by earning per share. Next, we have the price to sales ratio. Instead of earnings, this one compares share price to revenue per share. It's especially useful when the company is still growing, when the profits are unstable, for an example, during tough times or early stages of the development. So what is this ratio tell us? how much investors willing to pay for each 1 rupee of sales regardless of whether the company is profitable yet. To understand this better, let's break down the formula step by step. So, price to sales ratio should be calculated market capitalization divided by total revenue. Now let's move on to the third price multiple ratio. So thirdly, there is a price to book value ratio. So this links the market price per share to book value per share, which basically represents the company's net assets. So it's a popular ratio when analyzing the companies that own a lot of physical assets, like a manufacturing or bank. A lower price to book value ratio might suggest the company is undervalued, while a high ratio could mean investors see growth potential in tangible values like brand strength. Okay, now let's examine the formula used to calculate this ratio. PBV ratio should be calculated by stock price per share divided by book value per share. Finally, so we have the enterprise value to EBITDA ratio. This is a most comprehensive measure because it compares the company's value, including debts and to EBITDA, which is measure the operating profit. It helps us understand how valuable the company in terms of core business performance. Okay, now let's see a look at the formula behind this ratio. So, enterprise value divided by EBITDA ratio. To sum up it all, price multiples are powerful way for quickly evaluate the company. Each ratio gives the different perspectives, whether it's about profit, sales, assets, or operating strength. The choosing the right of the on depends what they are trying to analyze.
So, hi guys, I explained the value of preference shares. Preference shares are type of the share that give fixed dividends and safer than ordinary share because they take the paid first during the company liquidation. To find the value, we usually something called the perpetual model. This means we dividend the fixed yearly dividend by the required return rate. Since the dividends amount does not change, it gives steady income like a fixed stream of money forever. Because preference shares have a lower risk and investor often accept the lower return. This make them different from ordinary shares, which can give the higher returns than the also come with the higher risk. So, value preference shares is a simple boost value for the investor who want to stay and save income. Thank you.
Hello everyone. I'll briefly explain the share valuation process we follow to assess the value of Sierra Cables PLC's shares. This systematic approach ensures through fair and data-driven outcome. The process includes 5 key stages. First step is data collection. We begin with gathering curate the relevant data. This includes the company's financial statements from the last few years, stock market performance and historical share prices, industrial economic trends, and any other materials facts such as dividend policies and risk factors. These steps ensures that our valuation is based on real, up-to-date information. And the second step is financial analysis. Next, we perform an in-depth financial analysis of Sierra Cables PLC. This involves calculating the interpreting key ratios such as earning per share, price to earning ratio, return on equity, debt to equity ratio, and more. This helps us understand the company's profitability, financial stability, and overall performances. And the third step is selecting a valuation model. After understanding the financial health of the company, we select a suitable valuation model. Some common models include discounted cash flow (DFC) model based on future cash flows. Second one is dividend discount model (DDM). If the company pays regular dividends, we use D. And the next one is market-based approach, comparing with peer companies. In Sierra Cables case, we may lean towards the DFC method since it provides a future-oriented view, especially in a manufacturing company like this. And the fourth step is valuation calculation. Once the model is selected, we plug in the numbers, future expected cash flows or dividends, discount rate usually based on weighted average cost of capital, WSEC, and the next one is growth rate and other relevant figures. The result is the intrinsic value of one share, that is what the share is really worth based on fundamentals. And the final step is sensitivity analysis. Finally, we test the reliability of our valuation by doing a sensitivity analysis. This means adjusting key inputs like growth rate or discount rate to see how much the share value changes. If the value fluctuates too much, it indicates that the valuation is high sensitive and must be interpreted carefully. So this structured method ensures that our valuation of Sierra Cables PLC shares is not just accurate, but also defensible and reliable. Thank you.
My part is key document for share valuation. Accurate share valuation depends on detailed financial and industry insights. The following documents are critical: financial statements and corporate and industry data. Financial statements, annual reports, quarterly reports, income statements, balance sheets, cash flow statements. So annual reports is comprehensive yearly financial overview. Quarterly reports is periodic updates on financial health. So income statements shows profitability over time. So balance sheets shows assets, liability and equity. Cash flow statements track inflows and outflows of cash. So another one is corporate and industry data. There are also 5 corporate and industry data. Company prospectus, details on business model, risks and plans. Shareholder agreements defines rights and obligations of stakeholders. And another one is industry reports. Industry reports provides sector performance and benchmarks. Economic forecast is macroeconomic trends affecting valuations. Market research is insight on competition and customer demand. So my part is done. Thank you. We'll go to the next slide.
So I will briefly explain the practical application of the dividend discount model, which is used by Sierra Cables PLC. So the method they use is the dividend discount model, or as we call it, the DDM model. The dividend discount model is a classic and widely used valuation approach that calculates the intrinsic value of a company share by estimating the present value of all expected future dividends. Sierra Cables PLC has used this model to understand the fair value of their shares. Now let's look at the assumptions and the models and how this model works. So basically, the required rate of return that they use is 12%, reflecting the return investors' demand for taking on the risk. And after the year 2024, they have used a dividend growth rate of 5%. So basically, how this model works is where you discount the future cash flows according to present value using a WACC rate as the discount rate, in which the WACC rate is calculated using the cost of equity and the cost of debt. And also they use a beta factor, which is as per their practice, they procure from Bloomberg, the magazine, where they use this beta factor to incorporate into their WACC calculation. And after getting this discount rate, they will discount these future cash flows, where they have projected a 5-year cash flow using a growth rate which is tailored to their company's risk and their company's revenues, and obtain a free cash flow which they discount using this WACC model and getting the present value of these cash flows. And also, like, after you get these cash flows, you can basically calculate the terminal value and incorporate that into these 5-year free cash flows and get the total value in use. So as we call it, the present value of these future cash flows, and you can basically compare it with the carrying amount to determine whether the valuation is appropriate or not. And if you look at this chart in the slide, you can see that the darker bars represent the dividend per share in LKR, and the lighter bars show estimated growth rate percentage. Basically, this chart illustrates how Sierra Cable PLC has projected its dividends and estimated growth over from period 2020 to 2024. And as far as the darker bars represent, it shows a consistent increase from 2020 onwards, which reflects a healthy performance and commitment to shareholder returns. And the lighter bars, which peaked around 2021 and 2022, and is expected to stabilize towards the 5% term long growth rate post 2024. And in conclusion, by applying this dividend discount model, Sierra Cables PLC can calculate the present value of these dividend streams to arrive at an intrinsic share price. This provides investors and management with a reliable valuation benchmark on future cash flows rather than market speculation.
Hi, I'm going to talk about the importance of share valuation. Share valuation means finding the true value of company shares, and it's very important in financial world because it helps people to make better decisions. First, it helps in investment decisions. Like, investors can see if a share is undervalued or overvalued. So based on that, they know when to buy or sell a share. Second one is useful in mergers and acquisitions. When one company wants to buy another company, based on share valuation, it helps to take a fair decision to check if the deal will benefit to both sides. And the next one is portfolio management. It helps investors to build and adjust their portfolios based on changing market conditions. And it's also important for financial reporting, since companies need to show the correct value of their assets for transparency and legal compliances. Finally, it's used for legal and tax purposes, for example, estate planning, court cases, and tax assessments. In short, share valuation is a key tool in finance that supports smarter, fairer, and to make more informed decisions. Thank you.
Hello everyone, my name is Lukman Naufal. To sum up this presentation, I would like to come to a conclusion. So to conclude, share valuation is not a one-size-fits-all process. It requires the use of different models, reliable data services, reliable data, and clear understanding of the market environment. For Sierra Cables PLC, these aspects are crucial for proper financial planning and informed investment decision. So there are 3 points I have taken. Like the first one is no single model is perfect, so it's better to use a mix of methods like dividend discounts and dividend models and price multiples. So the second one is accurate data is essential for correct valuation, because like a wrong data or wrong information can lead the share valuation to a mislead path. So the third one is broader context, like industry trends and economic conditions must always be considered. So yeah, thank you for your attention. I hope this gave a clear understanding of the importance of share valuation.
Thank you for watching. We hope this video helped you understand how share valuation works and how it can be applied using real company data like Sierra Cables PLC. If you found this useful, don't forget to like the video, subscribe to our channel, and turn on the notification bell so you won't miss our future content. Feel free to leave your questions or suggestions in the comments. We'd love to hear from you. See you in the next video.